Her executive vice president title, given to those among the highest level of revenue production, is shared by approximately 75 of 3,000 professionals. Excuse me. Within the CBRE's national platform. She is the founder and leader of the team Lustig-Bower, a group of 8 professionals specializing in sales of apartment buildings, condominium conversions, reversions, and land for development for multi-housing properties. In the past 16 years alone, Ms. Lustig-Bower has been rated as one of the top brokers in the United States for the past 25 years. As one of the first brokers to focus on marketing Los Angeles properties to the international market, Ms. Lustig-Bower is known for selling the 8-acre Robinson's May development site at 9900 Wilshire Boulevard in Beverly Hills for over $500 million in 2007 to a London-based buyer, and then again in 2014 to a China-based buyer. We have Jung, who is the co-founder of Brick+Work. John served in the 82nd Airborne Division as a scout paratrooper, and after tours in Egypt and Kosovo, John learned that one of the most important factors in resolving conflict were having empathy for everybody involved and staying the course when all communication has broken down. It's this core value that has led him to want to get into the mortgage industry in 2009, shortly after the real estate financial crisis. He would eventually launch a True Path lending company, a fintech real estate loan company, to try to solve many problems of an antiquated industry by leveraging the latest in technology to deliver the most efficient and pleasant experience for borrowers. With his experience in technology, his next challenge was to find a solution for the growing housing crisis, and in Los Angeles, and identifying how challenging it is to navigate through the complex zoning code to help in the initial identification and initial due diligence process. This has led him to team up with Alex Irvine to start Brick+Work, a platform that is providing this information at a low cost point and working to build more tools and provide relevant data that can help stakeholders innovate to develop smarter cities. And we also have Steven Anderson. He's the managing director with Fifth Street Ventures. He's a developer. He has 16 years of experience in real estate acquisitions, entitlements, design, capital raising, and development. Recently, he had led acquisitions and development for CityView. Prior to joining CityView, Anderson worked at a redevelopment agency of Los Angeles for 5 years, where he managed the approval and financing for more than 1,000 units of the market and affordable housing across Los Angeles. Prior to that, he worked at a lending company where he was financing entitlement expansion projects for the firm's mall portfolio, and from there, he also has a Bachelor of Science in Planning and Development and a minor in Architecture and a Master's in Real Estate Development from the University of Southern California. And with that, I'd like to welcome our panelists here. Thank you all for joining us today. And I'd like to start us off with some questions that we could review. You also have my bio there. You guys, I want to present myself as the president of CCIM Greater Los Angeles. What I do as a profession, I run our family enterprises mortgage debt fund. We do private and alternative financing in the state of California and major markets. And, I volunteer my time with the CCIM organization to provide this type of content to our audience and to our members, to professionals in the industry. So now we will start with an initial question as I gave a little brief prologue of, how do we make projects in this environment actually pencil? Somebody would like to, I think we want to address that with Steven. I think, Steven, if you can kind of give some insight.
Sure. So maybe I'll start. Thank you for that kind introduction, Francisco, and thanks to everyone on the Zoom today. I hope everyone is safe and healthy. I'll start maybe with where we were pre-COVID.
Oh.
In Los Angeles on exit cap rates, and Laurie might have some opinions on this, a lot of people were underwriting a 4.5% exit rate, and we're being aggressive, only 1% or 100 basis points above that at 5.5% going in yield, 5% vacancy, and assuming 2 to 3% rent growth year over year. Today, when you talk to capital, if they are interested right now, rather than a 5% vacancy, they're underwriting a 10% vacancy, which is significant. Most people feel exit cap rates for sales valuation will hold because interest rates have declined and we're in a very low yield environment. And at least for multifamily, it's still considered a lower risk investment, and people like the idea of owning apartment buildings in high barrier to entry markets like Los Angeles. But they're assuming 25 basis points over that 4.5 exit, so 4.75 rather than 4.5, and no rent growth for 2 or 3 years. So, you know, on a large asset, that can be tens of millions of dollars in value. Capital thinks the first place we're going to see distress is probably in land. Land is the most elastic, and so we might see land fall, especially if owners have retail or hospitality exposure.
Right.
And other things, I think Fifth Street Ventures, our theme going into pre-COVID, where there were large macro themes in the market of community, security, and affordability. So a lot of these buildings with their amenity programs address creating community. Most millennials and Gen Zs don't have 3 people they can call in an emergency. There's a lot of isolation, loneliness in these generations, and these buildings were really trying, and I think some of them quite successfully, to create that community that people long to have in person in this digital world. That's only going to continue. We're just going to have to be more creative. The other 2 themes were security. We live in this very polarized, intense world. So when you come home, you just want to be comfortable. And then affordability. Affordability is going to be king out of this. So while we were maybe being aggressive and optimistic at pushing how high rents can go they go $5 a square foot, $6 a square foot, we're going to have to completely look at that paradigm and open up affordability both on the affordable and market rate side because of the employment situation and just the realities of the world we live in.
Right. Well, thank you. And, you know, looking at all those challenges, I mean, we have Laurie here, who's a broker in this whole entire, you know, who's on the ground on everything. I mean, what challenges are you seeing in all this? I mean, I'm sure you're seeing similar things, but if you can shed light on that.
Sure, yes. So with the pandemic going on right now, we definitely are feeling a lot of challenges from the marketplace. The first thing was basically the current transactions that we were working on started to feel stress. The buyers were concerned about continuing through on escrows that they might have opened. And in some cases where the buyers had already waived their contingencies and their money was non-refundable, they may have tried to see if there was a way to wiggle in a discount on the price. They just think that there should be a COVID, you know, discount, or ask for more time to get the deal closed. And there was some talk at points in certain transactions where the buyers might have threatened the seller with litigation, saying that this is a pandemic reason, that it's not the buyer's fault, that the buyer should either be able to get out of the contract or be able to modify it somehow. And the seller is having to try to defend that. So fortunately, on some of the transactions I worked on, the seller was able to give the buyer more time to get the deal closed because the buyer said they lost their lender. They had to go find another lender. There was one where the buyer did have some non-refundable money up, but just said to the seller, look, you know, because of X, Y, Z now, you know, we think we need a discount on the price. And across the board, I think at CB, when we've talked to all of our brokers, we're seeing that if there is a price discount, it's been very minimal so far, where sellers have actually agreed to give something. Where they've asked for a tremendous amount of money off, I've seen one buyer ask for almost a third of the price off. The sellers just said that's ridiculous, and and that transaction fell through. We've also had another transaction that was in due diligence, and the buyer was using money from a sale of another property, and that buyer got spooked because of COVID. So that spooked our buyer to buy our property, and that transaction fell out. But what's interesting is that on that one, the seller was motivated to get it sold. So we put the property back on the market right away. And without going into a whole lot of detail, it was a vacant apartment building that had just been vacated because the buyer had requested the seller empty it out before the close of escrow. And so the seller had finished emptying it out. It was in great shape. And we put it back on the market, figuring during the pandemic, people could still tour it. They could do it on their own. And I was really surprised. We released it to the market in the first week of April with a due date of April 30th. So right in the heart of like the worst time of the pandemic. And it was amazing that we had a lot of activity. Within the first 2 weeks, there were 156 investors that had entered the data room to check out more information about the property. And by April 30th, we received 24 offers on that asset. And that was, I mean, in normal non-pandemic times, we wouldn't have seen that kind of activity. So my thought was maybe what happened out there is that because a lot of people pulled their properties off the market, the ones that were on the market that were well located got a lot more attention than they normally would have. And pricing actually came in stronger than where we were pre-COVID. And so I thought, so it was almost counterintuitive of what you might think during a pandemic that you could experience. But maybe that was an aberration, I'm not sure. However, we are now talking with some of our very seasoned sellers who are saying that they want to get to the market now with properties because there seemed to be some optimism with the world, I think, settling into how this COVID is going to play out. And I think the state's starting to open up. So they're thinking that now would be a good time to take property to the market. And we're getting ready to launch some properties that we've held back on launching.
Wow, that's great insight. Very counterintuitive to the nature of this marketplace. As you guys see the civil unrest that's happening, that's great insight, Laurie. Thank you.
Sure.
And going back to Stephen, as you can see, some of the unintended consequences that are happening as a developer. I mean, as an owner, can you share a little more about other challenges that you're facing on the other side of this? Whether considering to sell or just other challenges that you're having. You're on mute.
Thank you. I think the challenge right now is we don't have clarity on the demand curve, right? So we don't know how long it's going to go. We don't know when this will come back. I am personally, and many of our partners are optimistic for the entertainment industry in LA. There's a content war going on, and shelter in place is like the best possible thing ever for Hulu and HBO Max and Apple and Netflix, worth more than Disney. So we expect that there'll be a robust filming comeback for LA specifically, where they're not, rather than just one season, doing 3 seasons and not flying to Vancouver or New Orleans or Georgia, but here and filming here in LA. That might not affect all of Southern California, but it's certainly a driver for core LA. But until you have clarity on the demand curve, it's hard. You really have to have a point of view and a belief and go into it. And then capital that would transact right now, and Laurie probably would agree with this, that it feels if you're doing a deal right now that you're early, so you want to get paid for being early. And there's still a lot of bid-ask spreads on people who are well capitalized, and then the stuff that's in distress might be stuff that you don't want. There's talk that 30% of retail and restaurants might not reopen. So do you want a retail center that all of a sudden can go to zero when it wasn't thought that it could go to zero before, even in core LA? I think on the multifamily side, projects that have large mixed use exposure and retail components are less desirable, and one of the projects we were involved in and looked at selling was retraded during this period where 10% of the revenue was from retail. And the buyer came back and said, we know, it's fully leased, but no one's open. None of these people have the credit worthiness of a Rite Aid or something like that. So we're going to not really value the retail at anything, just given where we're going right now. And then office is kind of, people don't know. A lot of people say, well, we'll come back in shifts and this will be a hub and spoke model. For young people, workplace is a team sport. You need mentoring and coaching, so not everyone can work from home. There's diminishing returns over time to that. But at the same time, people want to feel safe. And so I hear from a lot of people, yeah, our office will open this year, but I know someone who has a health condition or this or that, I'm not going back. So it's yet to be seen.
Very, a lot of valid points there. And, I really want to go back to an initial statement that you shared earlier about being first and being compensated for being first. Folks, there's a lot of investors out there that talk about risk-adjusted returns and looking at risk coming back into the market first. I mean, how do you make some of these projects actually financially feasible with that financial demand? I mean, could you speak about that? I think, Laurie, you might be able to review that.
Well, let's see, Stephen, do you want to talk about being early as you just,
Sure.
Do you want to, and then I can chime in after?
Sure. So we had tremendous confidence on the demand curve pre-COVID. We felt strong on the economy. We had lowest unemployment rate ever. Los Angeles has the 2028 Olympics coming. There's a scarcity of space. So people felt comfortable accepting a lower yield because they felt it was a relatively high probability that they would achieve those returns. Now there's massive uncertainty in the market. We might be seeing rent declines, people being able to delay their rent for 12 months after we declare that the pandemic are out of a major health event. In a way, that might be a good thing for scarcity because it takes some inventory off the market. But these are all challenges that new buyers and new investors are trying to understand and assess the risks of. And for that increased risk from where we were on February 1st, they want more spread, more yield, and more ability for if certain things do go not to plan, that the deal can still make money for what their returns are. I think a lot of people are accepting lower returns. We were in this 18 to 22% IRR world, kind of in the beginning of the cycle. Then we went down to 14 to 16%. Now a lot of capital is comfortable at 10 to 14%, but still all of these things have to play out if you're going to develop a brand new building and build it. I think people are more comfortable with entitlements right now. You definitely don't want to, ideally it's not great to be delivering right now in 2020 or maybe even 2021, but people are comfortable with 2022. This isn't going to last forever. And there's a flight to quality, kind of like Laurie mentioned on her deal with the level of offers. So I think it comes back to having a point of view about your market, your product, how does it fare in this new environment that's more focused on affordability, security, and community, even if it's hard to get people together, and you have to make a decision based on uncertain information like you always do in real estate.
Great point.
And I would just dovetail to say that that from a multi-housing perspective, when we've got land for development, and it really makes sense to program the property with apartments on top and some retail on the bottom. To your point, Stephen, we are seeing a lot of our developers come in and say, we can't really underwrite the retail component of that new project. And unfortunately, in some cases, if the property was in a pretty good location with a high rent for retail, where we were seeing, retail at like $7 triple net a square foot, even if you don't have that much retail in the project, it has a big impact on the land value if people are going to be pessimistic and think that we're not going to be able to get those kind of rents. So we are hearing that in some of our properties that are on the market right now that have, you know, some retail on the ground floor. So that's definitely an issue. The other thing that we were experiencing even pre-COVID was just financially underwriting these sites, because the construction costs have gone up so much in the last few years. It's just been exponential, it feels like that. And the rents haven't been able to climb as much as the construction costs have gone up. So what it's forced us to do is to model these new projects without subterranean parking, and trying to get because when you build a building, the most expensive way to build it is if you put the parking underground. If you can get the parking above ground, that makes it less expensive, and you could build it whereby the parking could be in the first 2 levels of the building, and then above that would be the apartments. And so we try to design our buildings that way to see if that might help it pencil, you know, financially. In some cases, it can work. In other cases, we can't even make the construction cost for putting the parking above grade in the building work, and then we resort to a cheaper way of construction, which is just putting the parking in an open parking lot. Like if you go to the supermarket, you have just an open parking lot, and putting the building right next to right in the parking lot, so that there's no parking underneath the building. And that's the cheapest way to build. And in some locations, that's the only way we can get a positive land value for the property. If we design it with the parking in the under the building, the land value works out to a negative. So that's been a big challenge. And then, you know, it's definitely been helpful with the TOC, that's the transit oriented community legislation. They've decided that properties that are near mass transportation can have an extra bonus of building more units, and they don't require you to build as much parking as the normal code if you're located within a certain radius of different types of transportation. If you're right near a metro stop, which is like a subway, you can get the most density. If you're by a bus stop, you can get some there's different levels between 1 and 4 of how they grade how close you are to mass transportation. And that's been very helpful to make sites more valuable. Obviously, if you own something near a rail station and you can get higher density, then you can get more money for your land. The question is, though, how you park it, because if you build more units, you have to provide the parking. And even though the transit-oriented community code regulations allow you to build less parking than what normally you would have to build, the question is, will the market accept that? So some of our clients are saying, you know, even though we know we can build it with less parking and like not have parking for some of the units, we don't think we can lease those units in Los Angeles. We think a lot of these tenants that are going to pay high rent are going to want a car. So it's not leasable. So when we do our underwriting, I always park it. So I get at least 1 space per bedroom if I can. If I can't, maybe I'll give a 2-bedroom, just only 1 parking space, and that might help. But I have to take in consideration, we might not get as much rent as we thought we would get. So it's a complete balancing act. And it's almost like a puzzle. When you do these analysis, you've got to kind of figure out how should I park it? How should I design the building? How many units? Is it worth doing more units, but then it's going to be more expensive to park it? So we're constantly trying different models on paper and running a financial analysis with it to see whether or not the way we design the building makes sense. And we were looking to find what is the sweet spot where we could drive the highest value for the land. And it may not necessarily be building the most amount of units.
Laurie's exactly
Wow.
right. The last deal we closed, a TOC deal closed this time last year, and it had reduced parking. But when we looked at market and did a Greystar survey of all the Class A buildings that they manage in Core LA, they averaged 1.7 cars per unit. So even that expensive 1-bedroom, you might have a couple with 2 cars. And to Laurie's point, at that price point, it's a consumer expectation that you have a place to park both your cars. We were getting creative on the sustainability side before this all hit, of doing flat garages that you could convert to office, housing, or retail over time. I think a lot of people have taken, unfortunately, I think COVID has put, we're in a safety before sustainability world right now, as we're seeing with disposable everything, and some of that will take a back seat. And people are probably going to drive more, commute more, use transit less. So if you are going to lean it all on less parking, you really need to be in a place that has walkability. And those places are usually quite expensive across Southern California, because walkability is, by some people's accounts, the ultimate amenity.
Wow. And great insight, both. Thank you. And this sounds like you both are using a variety of different tools to help you figure out all this information, because you're constantly figuring out the puzzle. So, I mean, can you guys share a little bit about some of the tools that you guys are using to reach these conclusions, to actually, you know, make good decisions? I'm not sure if Laurie, if you want to share, if you have any tools that you guys want to bring up that you guys are using.
Sure, I can start. So I would say that definitely, I mean, probably our number one tool is brickworks. I think that that's an awesome technology that you've developed. Basically, in the past, my team and I would have to scour through all the zoning codes, and if the property's in a specific plan, you know, sometimes comb through 600 pages of zoning information and try to extract out what you could build on this property. And sometimes it gets very complicated. It's not so straightforward. And then all of a sudden brickworks popped up, and we found out about it. And basically now all we have to do is just submit the address to a company called Brickworks, and they give us back a report that basically tells us what can be developed on the property, how many units, and it's been great. And what we also really appreciate is that sometimes some of our sites are a bit tricky, and the ability to call them back and say, you know, we don't understand how this impacts the zoning. Do you know, and to get their professional opinion on what, for instance, a queue condition might require, or some paragraph in a specific plan on page 592, and to have a resource to be able to give us confidence in what we're assuming is the right assumption is actually, in fact, the correct way of looking at it. Because if we make a mistake in that zoning on our model, we've now thrown off the value, maybe even substantially, for our client, and then we take it out to the market with the wrong value expectation. That could be a huge problem. So that's been I think our number one tool. Following that, obviously we look up zoning codes on the website. So the ZMIS is the LA City zoning resource, and so we're on that all the time, which gives us all that background information, which is what Brickworks is looking at as well. And then other things in terms of valuing a site. We need to do a rent survey. There is a technology called, it's produced by Yardi, and they basically track apartment buildings, typically over 50 units. And you could put in a certain radius area that you're interested in, and it will shoot you back all the buildings that are in that area with a detail of the rent that they're asking, and all the amenities that the building offers, and there's pictures. So that's been very helpful for us to understand what the rents could be in our new project, because we look at what rents are in the neighborhood projects. And then there's another tool we use is called axiometrics, and axiometrics is good for showing us what is currently in the pipeline for development. And it breaks it into different categories. It tells you what projects are being proposed in a certain area. So these are just developers with plans that they're thinking of doing, you know, a 300-unit apartment building here or there. So there's a category for projects that are just proposed. Then there's a category for projects that are actually in planning. And then there's another category for the projects that are under construction. So you can see the ones that are currently being built. And then lastly, they have a category called projects that are in lease up. And so this can be valuable if you're looking at a land site and you want to know, like, what is the competition going to look like for your land when one day a developer will be building on the my subject property. I look into the future and seeing, are there going to be 10 other buildings in that submarket that are all opening up at the same time? So that's another great resource to look at. And I don't know, Stephen, do you have any others to add that you look at?
Sure, I think that was a great summary. Alex Irvine and John, who's on our panel that created Brick+Work, is fantastic. I've successfully entitled projects with Alex's firm. And it's really important, especially in a transaction, for both the buyer and the seller to have kind of an equal understanding of what the buy right opportunity is. There's always the opportunity to sort of go for the home run and full zone change, but where things really go off the rails is if one party has a different expectation than the other in terms of going back to our previous discussion of risk, right? What is our approval risk? What is our likely outcome? And for a developer, sometimes the best thing is to say no quickly. So Brick+Work allows you to look at a site quickly and say, oh, I can only get 80 units on this. That's not very efficient when I'm running, you know, Class A operating expenses for an apartment building. I need something larger, and they're asking over $100,000 a door for this. It's a pass for us, moving on. And that way you try to minimize the amount of time that you spend on deals that don't work. And with Brick+Work, from a very high level far away, you can get an idea of if the project pencils or not, and then you kind of continue like a detective diving in and seeing if it fits. But Brick+Work really allows you to pass that initial density test, make an opinion on roughly what costs and rents are, an opinion on what you think land would trade for, and then from that choose to move forward or keep looking.
Great, thank you. And John, if you can take the floor and tell us a little more about Brick+Work.
I don't think I could do any better than Laurie and Stephen. So I want to thank both of them. But yeah, so I just wanted to, obviously thank you, Francisco, for kind of bringing us all together for this discussion and bringing value for everyone. But like they said, Brick+Work, we're an online platform. My partner, Alex Irvine, like Stephen mentioned, has his own land use consulting firm. So we currently cover all of LA and Orange County, and it's super simple. You just sign up, give us the address, or even thereabouts. We'll go ahead and do the research, and we'll provide it within a day. So next slide, please. I wanted to quickly just go over some slides. Essentially, I don't want to dwell too much on this, but this is actually a live site. And I have a sample report I want to share with everyone. This is 6232 to 6254 Wilshire Boulevard. This is actually off Wilshire and Crescent Heights. It's a big retail site. Next slide, please. This is a street view of the site. This is actually not on the market. We're just using this as a sample, but it's going to kind of lead into my point, which is, so next slide, please. This is the Brick+Work report. Stephen and Laurie, this is a newer version. We're going to be launching this one in about a month or so. So give me 1 second. Next slide, please. Great. So this is going to be our new report. We essentially, on the left-hand side, will cover the existing conditions, the zoning and land use, the jurisdictional. But on the right-hand side, now the new part, what I was mentioning to Laurie and Stephen, we're gonna actually have more use cases now. We initially launched for multifamily and mixed use only, but we've gotten a lot of requests from developers and brokers alike wanting, what about the accessory dwelling units in West Adams? Do you guys do reports on that? What about single lot 1 to 4 units? And then what about, given the environment now, flex industrial space or flex, office space or any other commercial use? Do you provide reports the information on that? So we're actually going to be providing that very soon. But as you can see here, the 3 columns, like both of them mentioned, there's the by right on this side. So it shows 204 dwelling units with TOC, the transit-oriented communities. This is tier 3. So you can build 349 units, but of course you have to also factor in the affordable. So you have 10% extremely low, 14% very low, and 23% lower. So, and then if any of the sites are not within a TLC zone, you can always fall back on the state's density bonus program. But obviously, you're going down to 277 units versus the 349. So that's always kind of the ideal route to go for a developer. So we also, calculate the setbacks and the buildable area. Ika, next slide, please. And so we also have what Laurie had mentioned, the parking and open space. Now, she's absolutely dead on. It's just because the TOC allows you to not park it doesn't necessarily mean now it's feasible, right, to not provide parking. So that's kind of the decision I think that developers have to make depending on where it is, location, and what their opinion is for what the market will do after the build. But and on the left-hand side of the screen, you're going to see our financial feasibility calculator. Now, I want to stress this. This in no way will replace the deeper dive, the 200-line plus underwriting models that Stephen and other developers use themselves when they actually go into a site that they're interested in. But what we wanted to create was more of a back of the napkin. So on the left-hand side, you're going to see building type, land cost, average rents in the area per square foot, and cap rate. Now, those are all fillable. We wanted our users to be able to kind of play with those numbers. And then you hit calculate and it comes up with, and again, these are very average construction costs that we received from polling a few general contractors at the time, and they were based on build type. So obviously type 1 is going to be, the all steel structure of the building that is going to net a higher construction cost versus the type 5 or type 3, which are, stick wood frame over a box. But, we just wanted to provide some additional tool to start the conversation to see if this is would be able to pencil for anybody. So that's it. I just wanted to make it super quick with the slides, and everybody that's attending this webinar, you're going to get a free credit for a report. I saw one of the questions asking for the website address. It's actually brickworks.la is the website address, but everyone here will get a free credit, and you could reach out to me or the team to actually go through a little bit more in detail these reports.
John, at the end of the webinar, can you provide your contact information for everybody? We'll make sure we post it so you guys will be able to reach out to him. But I do have a follow-up. I know you mentioned, you partner with Alex Irvine. I know he has his own land use consulting firm in downtown LA. I mean, right now, how are you collaborating with him? Can you share a little more about how, you guys fit in terms of the team, of the development? I mean, how do you guys, minimize the use or even the expense of land use consultants? If you can share more about that.
Right. So, yeah, that's been really the key point here by starting Brick+Work is that, Alex runs his own land use consulting firm. A lot of them consist of ex-city planners. So the way we kind of view Brick+Work is versus Irvine and Associates is Brick+Work is kind of the tip of the spear, right? So we're the ones that provide the initial due diligence, hopefully to more users to be able to get more sites looked at, right? From the viewpoint of obtaining the listing or getting Stephen interested in a development site and going into escrow and closing on it. But then they would have to get entitled, right? So there is no shortcut to city planning and the public hearings. And the Irvine team are doing that for numerous developers right now on live sites. So we get to take a lot of the information that's happening with those entitlements and bring them down to Brick+Work.
Great. Great, thank you. We are running a little short on time. We've got a couple more minutes for us to have. I think I'm gonna kind of go into some insight that you guys would like to leave to our panel, to our audience, and then give the remaining balance of the hour to our audience to ask any questions. But fundamentally, based on everything, I think I was informed that my other half of my initial statement was you guys couldn't hear me, but to kind of finish it off, we have a presidential election whose results are either way or will likely not be accepted by half of the population, which will lead to further uncertainty in the political markets. And with all the things that we're dealing with today in the marketplace, the stock market's only 10% down from all-time highs. So this environment comes with a lack of clarity and uncertainty in the marketplace, and investors rely on your opinions. So I mean, if you guys can share a little bit about what you would want to offer to our audience and to investors, as words of wisdom for what's to come, and we would appreciate any additional tips.
I guess I'll start. I think our industry has increased responsibility right now. It is about people at the end of the day, and we have sort of been exempt from being required to have brands and missions and a lot of things to consumers, renters, the people who use the real estate. And I think real estate owners that stand up and come up with something interesting and has true meaning for people and residents will have probably higher rents, higher retentions, lower concessions, because people are being extra judicious with their spending right now, and they want to feel good about where they put their money and know that it's more than just a roof over my head. My building, or whoever this entity is, stands for my values. I think we're being trained in ways we don't even realize. Digital service is not going away. I used to love going to the grocery store. I haven't been to the grocery store since March 1st. I get it delivered every week. These things aren't changing, and these are opportunities for real estate owners to, without actually increasing payroll, increase the level of service through technology. So that's really exciting, all of the different things we can offer versus what we were even able to do 5 years ago. And the fact that the renter pool of all ages has been trained, right? And then this whole work from home thing, it might not be here to stay for everyone, but certainly more people will work from home than they did February 1st going forward. And so we need to think about how do we design our buildings and our spaces that allow people to do that, because units that make it real difficult to have exactly what we're doing right now, a peaceful place to concentrate and have a conversation, are going to be less popular than units that offer that flexibility. Laurie, what do you think?
Yes, I agree with you. And it's interesting because I was just on the phone with a developer the other day, and they were talking about how they were going to design a new apartment building in light of the fact that they think a lot of people are going to appreciate a unit to be designed differently so that they can have a home office, which they think is going to be more important. And I said to them, well, the larger you make the unit, the less affordable it becomes because it takes up more square footage. And they said that their thought was not necessarily making the unit bigger, just cutting it up differently so that it's almost the same square footage, but it just has I think what they were trying to design is an office component embedded within a square footage that they would have offered before. So it will be interesting to see how that pans out. And what percentage of the workforce does not actually go back to a traditional office space. Although CB released a video on what their take was with office, and they think that actually office buildings over the past few decades, the pressure has always been to cram more people into less square footage. So per employee, the amount of space that you have the density is quite high. And so they think that in light of the pandemic, that now when employers think about space, they will think the other way in terms of how can I make sure that my employees have some social distancing even in normal times. So now we might not, so the upshot was we may not lose as much office space as one might think, because we may rethink the space that we do have and need more space for the same amount of people that we had before. But if all those people don't come, let's say 20% don't need to be in the office all the time, maybe we end up with netting out, keeping the same amount of space, because now they can just spread 80 people out over 100% of the area instead of, and not having 20% come back to the workspace. They also thought for mentoring purposes, we talked about that earlier, and when you want to retain talent, I think people expect to come to an office to have an interview and they want to check out what the office looks like. So I think that aspect of it too, and for collaboration, what's the lunchroom look like? I mean, people are still social animals, and I think there is still a need for them to be able to feel like they can go in and be a part of a group when it's appropriate. Maybe it's not every day of the week, but I still think we're going to need to have that office environment from that perspective. But switching gears to multifamily, what I have heard is that although we expect from CB's research that rents potentially will dip as far as 8% lower by fourth quarter of this year, CB is projecting that by first quarter of 2022, that we'll be back to the rents of where we were on, say, February 1st of 2020. So they think it may take us 2 years to get back to where we were before the pandemic. I've also heard from people, they're concerned that some people may lose their homes to foreclosure because they've lost their jobs, and they think that may bring more demand to apartments. So something.
Very great input. John, do you want to share anything?
Just quickly, I think Alex had shared that LA City Planning, obviously initially with the stay-at-home orders, had to kind of figure out how to get these cases moving forward, but they are now holding those public hearings over something like Zoom or Skype. So cases are moving forward. So, again, for anybody out there that's wanting to kind of look at Brick+Work to use as a prospecting tool, on the planning side, cases are moving forward normally. So if there are developers like Steven out there that are looking at sites specifically and they want to get them entitled, it's not stalled at all. It slowed down for obviously a little bit, but now they're up to speed. So that's what I wanted to share.
I think I'll say a couple things. That the planning department is under tremendous stress. It was before, it was under resourced. Having worked for the redevelopment agency in the past, that great, smart people work there. But I think we're going to see some regulation changes. Cities live off, property taxes go to the counties, and the counties are the biggest sort of tax collection money engines, and cities live off transit, hotel taxes, and retail sales taxes. And both of those are definitely impacted. And then we're pretty specific on this Euclidean, single use zoning through a lot of LA, and essentially everyone's apartment and home is now a mixed use project, given that you're working and living from home. So what does that do? Does that open up the meaning of live work a little more? I think maybe regulations got a little too specific or on the nose, and we might see some more flexibility from a regulation side to help aid the economy to move forward and get people building again, and helping our industry, which always lags consumer demand, be able to address that changing consumer demand a little quicker.
I just clicked on the questions. I'm going to just read this first one. It says, do you see financing for multifamily product tightening due to COVID and the impact it's had in the lending market? Rates have gotten low enough for buyers to emerge who may not have otherwise. So I would say that from the financing point of view, it's interesting. In the beginning of the pandemic, spreads widened and lenders got cold feet. We heard that a lot of lenders had pressed the pause button, and now it seems to have loosened up, and it seems as though rates have settled back down. And so I think it is becoming a lot easier to get loans. I'm getting emails from lenders saying we're doing deals. So I think it's calmed down a bit. Stephen, what are you seeing? Not only, I mean, I'd be interested from a developer's point of view, your equity partners out there, are they still pencils down or pause? Or do you think that if there's a site out there that there'd be equity partners for developers that they're ready to go?
There are definitely equity partners for developers that are ready to go if it's the right site, meeting the returns, and that bid-ask spread is tighter. But that comes back to that point of view. And if, you know, capital takes the point of view of 10% vacancy versus 5% vacancy, that alone changes the valuation of the property, and your loan will be smaller, even if they can go more aggressive on the LTV, loan to value. But if you take that value down by 15% or 10%, you know, your net loan size. So it's kind of a mixed bag. So I think I'm still hearing liquidity is a little sluggish. I think, again, you know, people like industrial real estate, they like multifamily, they like single family home rentals, they like digital real estate data centers. We're scared of retail, we're scared of hospitality exposure. So it's kind of a mixed bag, but, you know, in a gateway city, in a knowledge economy like LA, there's still a lot of capital searching. Just, it's kind of like a sheep mentality where everyone's waiting for someone to jump in. And if someone jumps in early, they want to feel like they're getting paid for making that early move.
Right. Well, thank you everybody for being here on the panel. We want to be respectful of everybody's time, and thank you for everybody for participating on this panel. We would like to thank Laurie, Stephen, John. Thank you both. Thank you all three of you guys for being on the panel, making the time to speak to our audience. And thank you all of our sponsors. And we really if we want to have John put your contact information in the chat box, please. And you guys will be able to get your free one report. And for everyone else, if you know, Laurie has plenty of listings, Stephen's looking for capital for projects, and I'm always looking for capital too. So we're all here trying to, you know, put deals together. So we really appreciate everybody's time, and we hope you enjoyed this presentation. Thank you again, and we hope you guys are staying safe. And